Welcome to the London Property Podcast, your trusted guide through the complex and ever-evolving world of London real estate. We help clients manage, protect, and grow their property wealth by connecting them with the right expertise from finance, law, and tax to construction, design, and strategic advice. Through conversations with industry leaders, we bring you clear, practical insight into the trends, challenges, and opportunities shaping the market. Let's dive in.
When safety beats tax. What clients who left London for the Gulf are saying, and why it changes the prime market outlook. For 18 months, the dominant story about prime London has been one of departure, non-doms leaving, wealth relocating to Dubai, Abu Dhabi, Lisbon, and Monaco. The Chancellor's hand on the back of the door, a drumbeat of exit interviews in the trade press, each one confirming the same arc. This week, sitting down with Gary Hersham for the London Property Podcast, I heard something different, something that should make anyone advising at the top of this market pay close attention to. Gary, who has spent 40 years selling some of the most significant homes in this city, told me he has personally taken 5 or 6 calls in recent weeks from clients in the Gulf who want to come back. One of them, a Russian who has been based in Dubai for 15 years, has a budget north of £50 million. Another is an Arab buyer who previously sold a London property and now wants to buy again. These are not test inquiries. These are people moving capital and family. Safety, not tax. What is driving this is not a softening of the UK's tax position. The non-dom regime has not improved. Inheritance tax exposure has not relaxed. The statutory residence test is the same as it was last quarter. What has changed is the perception of safety. The events of the past months, strikes on the Gulf, the proximity of conflict, the reminder that money can be ring-fenced in a jurisdiction, but human beings cannot have reordered the calculation for a meaningful number of internationally mobile families. Gary put it bluntly, money may be safe there, but it's not safe for human beings. His clients are reaching the same conclusion in real time on their own. This is not a tidal reversal. The exodus to the Gulf has been substantial, and many of those who left will not be returning. But the assumption that capital flows in this segment are one way is no longer supported by what is actually happening on the ground.
You're listening to the London Property Podcast. We help clients manage, protect, and grow their property wealth. If you find this conversation useful, don't hesitate to get in touch. Now, back to the conversation.
The other point worth lifting from our conversation is the widening gap between the very top of the market and the segment just below it. The trophy end continues to set records. Nick Candy's Holland Park house sold for £265 million through Marcus O'Brien. There are at least 2 other houses Gary believes could now command 300 million plus, simply because the comparable has been established. At this level, the buyer is not pricing the asset in square footage or yield. They are pricing it in the irreplaceability of the property and the size of their own balance sheet. As one of his clients told him recently, your instructions are not to lose the house for me. That is the psychology of the trophy buyer. The number is incidental. The asset is what matters. Beneath that, in the 5 to 20 million range, the picture is harder. The owners feeling the most pressure are those who bought between 2005 and 2007 or between 2014 and 2015 peak windows that have not yet been recovered in nominal terms, let alone after the transactional costs layered on since. For those owners, my view remains the one I have shared before. If you can hold for another 5 years, hold. If you need to transact now, but be pragmatic about price. And remember that you are buying back into the same market on the other side. Your buying power moves with you. What this means for the next 12 months. Gary's view, which I share, is that prime central London is stabilizing. The Gulf return flow, whatever its eventual scale, adds demand at exactly the level where stock has been thin. The supply side is constrained. Residential development at the upper end has effectively stalled because the maths no longer works once you add stamp duty and current build costs to acquisition. A 20 million house, fully refurbished to top standard, now needs to sell at 60 before the developer makes anything meaningful. Few are willing to take that bet. So the pipeline of refurbished, move-in ready prime stock is unusually thin, exactly what the returning Gulf buyer wants. That is the setup for a quiet firming of prices over the next 12 months, particularly for fully presented turnkey product. It is not the dramatic reversal some will want to call it. But for owners who have been told for 2 years that their asset is in structural decline, it is a different conversation. The market is not where the headlines have placed it. It rarely is.
Thanks for listening to the London Property Podcast. If you'd like guidance on managing, protecting, or growing your property wealth, get in touch. We're here to help. And if this episode proved valuable, share it with someone who takes the market seriously and make sure you're following so you never miss an update.